Good evening, investors, and thanks for tuning into the forecast. I'm Jake Ackerman. The market finished down a few points this week, driven by the Fed putting the brakes on the market rally, raising rates by 75 basis points, and then also raising their potential guidance on where they want the Fed funds rate to be. We were expecting the potential Fed funds rate from 4.5 to 4.75, right in the middle of 4.6 is what the Fed that they wanted it to reach. But Jerome Powell states that the Fed funds rate looks like it's probably going to go higher. Energy prices tick up a bit. The 2-year Treasury rate makes a new high. The 10-year Treasury rate does not make a new high, but it creeps back up to its all-time high. Now, the silver lining in this bad news that we got this week is, first off, the Fed acknowledged for the first time that their tight monetary policy, their rate-raising campaign, has had an effect on the economy. They're seeing signs of it in housing, in rent prices, and earnings reports. Well, it's not, the earnings reports were actually good. It's more of expectations. So they're seeing some damage done to the economy, what is exactly what they wanted to see. And we continue to see signs of deflationary events taking place, added inventory, housing prices coming down, rent prices coming down, and energy prices generally have been in an extreme decline these last 4 to 5 months here. Now, with the Fed acknowledging that they've actually done damage to the economy, which is a goal that they stated they wanted to see. Another good point that we have was actually some data that we got today. The unemployment ticks up a bit. It ticked up from the expectations of 3.5% to 3.7%. Another data point that the Fed said they wanted to see. So that's another check in the pause bucket. Now, there's been some discrepancy on a Fed pivot, and that's the difference between a Fed pause and a Fed cut. Cuts are going to come way later in 2023, perhaps even in 2024, but there's got to be some serious damage done before we're going to get some rate cuts. What's most likely going to happen, and what is going to happen first, is what the Fed stated, is going to be a pause in the rate hike campaign, which we're going to see first quarter, second quarter of next year if the timeline remains of what the Fed stated their timeline is going to be. So given all that, the Fed said their target range is going to be higher than they projected last month, and before they even stated that, the market already had that priced in. If you look at the betting odds, the forecast, before the Fed even spoke, that target range was already higher than what they said. So that means their target range expectations, what they stated was going to happen, was already priced in, which is good news for the stock market. The stock market is going to continue to rebound even if the economy, the real economy, is coming down, because the market, the stock market, the bond market are significantly forward-looking. I mean, 6 months, 9 months in advance, that's what we're seeing right now. So what could be a conundrum really is, why is the stock market going up? Why is the real economy and unemployment, real economy going down? Why is the unemployment rate going up? That's the same question could have been asked earlier this year. The real economy was strong. The stock market was kind of coming down. And that is, folks, that is what's going to happen, is the stock market led on the way down. The stock market is going to lead on the way up. So just because you're hearing bad news about the real economy doesn't mean it's bad news for the stock market, because the stock market's already priced that in. So that's, once we get that timeline, once the Fed continues, as the Fed continues to be dovish, which we believe that he's going to be these next few meetings more and more dovish. We got a little more dovish this meeting, probably a little more dovish next meeting, and so on and so forth, as long as we continue to see, unfortunately, more job losses, which we just seen, and we continue to see inflation data coming down. last week we talked about the PCE data that was released was lower than expected. CPI's numbers are going to be released on Thursday. We'll be tuning in. We'll be watching that closely because that is going to be a hyper important data point to where we go here for the next month. So stay tuned. We'll check back in on Friday, give you the update of what we've seen. Thanks for tuning in. Jake Ackerman with Ackerman Financial Group. Experience you deserve, expertise you can count on.